Hey, welcome back to Yellowhammer Radio. You're listening to us on Superstation 101.1 WYDE. Andrea Tice here with Scott Chambers, and we're about to introduce Jeff Roberts. He's the founder of Jeff Roberts and Associates. Jeff's team consists of 7 seasoned advisors, and they together have 125 years of financial planning with Ameriprise. Barron's Magazine has placed that company among the top 1,200 financial advising practices in the country. Not once, Scott, not twice. Go
3
ahead.
times.
No. You
4 times?
6 times.
6 times. No way.
Yes. So you can tell he's a local guy who's doing big things.
Absolutely he is.
And so Jeff's team specializes in working with affluent clients to help them preserve and grow their wealth. So they are the go-to team in town for customized recommendations in regards to estate planning, retirement planning, or asset management. So we are very glad to have Jeff on board to keep us financially sound and growing. Hey, Jeff, are you there?
I am. Good to be back.
Good to have you
guys
back.
Last week.
Yeah, we missed you last week. You're a little out of town doing some work, I take it.
Yes, I was in Las Vegas attending the Barron's Top Team Summit for the week, and it was very insightful and good conference.
So is Barron's Magazine going to come out with another listing like you guys have seen before?
They are. It's any day now. In fact, the room. It's normally the first week in February, but we're hearing that it may be the first week in March before they come out with their new list of the top 1,200 advisors or so.
Okay.
Well, I have a feeling you're going to be smack dab right in the middle of it again, Jeff.
Yeah, it may be the case, but listen, to get it once is like winning the Super Bowl.
Right.
And if you get it twice, it's a validation. Any more than that is just unimaginable to me. So
6 times,
I don't
Jeff.
expect it.
Yeah.
6 times.
So
That's
that
amazing.
and if it goes to 7, that's going to be really
Yeah,
impressive.
It's hard for me to imagine, but we just want to serve our clients well, and if
Right.
the accolades come, that's even better. So.
Well, Jeff, if you happen to hit 7, Scott and I would be happy to come down to your office and provide party ambiance.
Yeah, we'll bring party favors, Jeff.
You provide the food, but we'll be there to eat it.
Remote.
There you go. There you go. Well, Jeff, something interesting while you were out of town, and this has been going on for a little while now, but while you were out of town especially, the market really started hitting just record all-time highs, man. What the heck can we take away from that?
Well,
if anything,
one, it's exciting and it's good. We love all-time highs. And, I always talk with you guys about themes and topics that I hear about during my meetings during the week when we're sitting down with clients. And it's interesting because when markets hit all-time highs, you would think that everybody's all excited. Oh, this is great, and high-fiving. But actually, it's amazing how fear sets in. And people begin to think, well, because the market's hitting an all-time high, that means I need to get out and it's going to be bad. And so I wanted to touch on that a little bit today in terms of just some historic numbers and patterns. And I'm going to reference a lot of data and percentages. And the main thing I got to tell you is I'm getting it from a lot of sources. I mean, there are good friends at J.P. Morgan provides a great deck of these of information. Fidelity Investments also gives us some of the stats that I'm going to give you. And then there's simple websites where we can gather historic information like bigcharts.com or DQYDJ or Yahoo Finance, all kind of compile this data. But to first understand what this stuff is, let's just talk about the Dow just generally, because most people follow the Dow Jones Industrial Average. And it started back in Charles Dow started his first index in 1884, but it wasn't until 1896 that the industrial index first came out. It was 12 stocks at that time that kind of made up the industrials. And I'm just curious, do you all happen to know, here's a question, how many stocks comprise the Dow Jones Industrial Average today, by chance? Y'all know that one? I'm putting you on the spot.
Okay, so just so I'm clear, Jeff, stocks indicate individual stocks represent a company.
Individual stock represents one company, and the Dow Jones is a collection of a measurement of a certain number of stocks.
Okay.
And I'll give you the answer. It's 30.
30. I was going to guess 30.
Well, that was he was not guessing, Jeff. He was Googling.
He's Googling it. He's looking at it. I should have realized you guys had the laptops there. So, okay, so 30 stocks comprise the Dow. And now here's an interesting one. Now, keep in mind, the Dow's been around 120 years. Can any of you guys guess which company has been on the original list all the way back 120 years?
Andrea, go for it.
Oh, 120. Oh, my gosh. I got to think of a company that's been around. Can Ford Company be on that? Because that's been around.
I'm going to say General Electric.
There you go, bud.
Yeah,
There you go.
I didn't Google that, Jeff Roberts.
You did not. So yeah, that's there's been one company that's been on there the entire time, and the list changes from time to time and reflects today versus years ago when it was maybe more railroads and that sort of thing. And then there's indexes that maybe are a little bit broader, like the S&P 500 index, that is a listing of 500 stocks as opposed to just 30, which might be a little bit broader view of what the market's doing. It dates back to 1923 in its original form, called the Composite Index, and then started with 500 stocks actually in 1957. All right, all you need to know about the basics. But let's talk about the U.S. stocks. You know, they're hitting all-time highs. Some people are getting nervous. And so, you know, maybe we need to get some perspective on what that actually looks like. And there's an economist, Ken Galbraith, back in, he was probably back in his prime in the 50s, and he has a quote that says, "The function of economic forecasting is to make astrology look respectable." So as we begin to pontificate markets and projecting and past performance, who knows where markets are going to go. But here's some perspective. If you look at the Dow, which is kind of what most people see when they're paying attention to the market, the stock market, and if we go back 90 years of history, and you look at what's the average performance been of the Dow for the last 90 years, the number from January of 1926 to January 2017, the average return is 9.76% roughly. So let's just round and call it 9.8% roughly. So you've got a machine for 90 years. It's averaged 9.8. And people say, yeah, but that's over 90 years, Jeff. It's that's not indicative of anything. Make it, it's not relative to us. All right, well, let's do 20 years.
Okay.
So if you go from 1996 to 2017, the average is 9.1 on the Dow. And if you go back 10 years, in the last 10 years, from 2006 to 2017, it's averaged 8.44. So a little bit less. But remember, we also had, during that 10-year period, we had the second worst period of time in our market's history.
Yes,
with
we
the
did.
Great Recession in 2008. Y'all remember that?
Yes, we
I
do.
can't forget that one.
If we go back 5 years, the last 5 years, the market's averaged 11.8.
Huh.
So if you think about this, you say, well, Jeff, whether we dice it 5 years, 10 years, 20 years, 8 years, it's gone between roughly 8.5% and 12%. So let's call it, say, somewhere in around 10% is what the market has historically done when you just look at the averages. And so that's, you think about a performance number, that's actually pretty good.
Mm-hmm.
Year to date, the market's up 4.1% as of the market today. And if you look at what's happened with the market since Trump got elected, it's up about 12% since Election Day.
Wow.
So we've seen strong performance. So here's the question I would ask. All right, so if you've got a machine that's been cranking out roughly 9.8, call it 10% return for the last 90 years on average, and at 10%, your money's doubling about every roughly 7.2 years roughly. So if we've had this machine that's cranking out money that doubles every 7+ years, why isn't every American wealthy?
That's a great question.
Why isn't everyone benefiting from this? Well, the reason, and I've contended this for years when I do workshops, is because I think we as Americans tend to believe in things that don't exist. Like Elvis still alive or Bigfoot or something like that. But we believe that the market's going to crash and go down forever, or it's going to go to zero. And we make up these scenarios in our heads, which cause our behavior related to investing in the markets to be altered. We tend to focus on the negative. And what's TV and the news do? Adds to that. So just because markets are hitting all-time highs, it doesn't mean panic, scare, or run, and that's what unfortunately happens with people. They're coming in my office and they're scared because the markets are hitting the high.
Right.
And so my statement to people is, this is kind of a broad statement, but markets are pretty much always going to hit all-time highs, because if you look at that 90-year trend, what do markets do? They always go up over time. They have crazy and wild volatility along the way, but generally stocks always go up over time. So they're always going to be hitting highs. But we tend to focus on those negatives in those short periods of time. Like, I'll give you an example. If you go back for the last 37 years and you look at the swings of the market every single year, 1 year at a time, all the way back to, say, 1980, the average decline in any year of the stock market, meaning from January to December, the amount of money or the level of decline the stock market could have had on average all the way back 36 years, the average has been 14.2% on the downside in any given year for the last 37 years. So you think about that a second. So, Jeff, what are you saying? So you're saying that any given year in the last 36 years, the stock market has averaged at some point during the year a decline of 14%. Yes. So that means if you're investing your money in stocks, you need to be comfortable with the fact that it could swing in any year 14%. Yes. True statement. But sometimes people forget that, because if we've gone for a year or two and we haven't had a swing down like that, then people start to get comfortable with the fact, well, stocks don't do that. Mm-hmm. And then when all of a sudden they drop 14% in a year or 15% or something like that, then people get nervous, panic, and move to the side. And that machine that cranks out that historic return is no longer working when you sit on the sidelines. So to get the averages, you have to have the pluses and the minuses. And so what we're experiencing now is good market performance, but we don't want to move to the side just because things are doing well. Here's kind of another statistic, kind of interesting. I had a client say, yeah, but Jeff, I mean, my gosh, it's doubled to get to $20,000 just in roughly the last 6.5 years. Mm-hmm. Because the Dow was at 10,000 in July of 2010. And so it went from July of 2010 at 10,000 now to 20,000. So that's 6.5 years. I said, well, it's about an 11% return roughly over that period of time, which is a little bit better than the market has averaged for a long period, but it's not crazy high. But what people forget about is, oh, yeah, so the market's overvalued. It's kind of what their thinking is. It's overvalued because of that analogy I just gave. But let's put it into greater perspective. The first time the Dow Jones broke 10,000 for the first time wasn't July of 2010. The first time it ever broke through was in April of 1999, which was 18 years ago. So it actually doubled from 10,000 to 20,000 today over an 18-year period of time, which is not nearly the high return.
Right,
so
right.
To keep this in perspective, the Dow to get to 20 today is just a double of where the market was in 1999. Does that make sense?
Yeah.
Right, it does, yeah.
So it's my thing that I try and message to clients is this. You know, as I mentioned, on average, we've seen historically for 36 years, stocks drop somewhere in a year about 14% on average intra-year. About every 3 months historically, if you go back to 1926, stocks dip about 5% on average every 3 months. Dating back to 1926, every 8 months on average, they go down 10%. And every 2.5 years on average since 1926, stocks drop 20%. We've gone 8 years since a drop of that size, which is one of the longest stretches. So our message to people is this: don't panic just because stocks are hitting the high. Be rooted in a well-diversified portfolio, but remember the performance that you get in your investment is a combination of two things: the investment results of the markets that we're in, plus investor behavior. And investor behavior is the part that we as advisors try and help clients influence.
Gotcha.
Make sure they're not doing the wrong thing at the wrong time.
Just be in it for the long haul. It's a long haul thing. No need to panic. Just this is a thing you're in for the long haul.
And it sounds to me like, Jeff, you're providing the fuller context of someone who studies it, knows the stats on the long haul, like the 100 years, and can say, let's put it in perspective. Here's your full spectrum. Don't panic.
That's correct. We focus very heavily on investor behavior
awesome.
Because that's the part we can control the most.
Yeah,
well, Jeff Roberts, you are an awesome man. Jeff Roberts and Associates. Tell people how they can get in touch with you, good sir.
Give us a buzz at 205-313-9150 or jeffrobertsandassociates.com.
All right. Jeff Roberts from Jeff Roberts and Associates. We look forward to talking to you again next Wednesday, Jeff.
Thank you.
You have a blessed day. Jeff Roberts and Associates. 205-313-9150.
And if there's anybody out there who is panicking over the situation just because it's going up, and apparently there are that are out there, then call Jeff.
There you go. He's the right guy to talk to. No question about it, and a nice guy, too.
Yes.
Awesome dude.
He'll put you at ease.
All right, we'll take a quick break, come back, wrap this thing up for this Wednesday edition.
This is Yellowhammer Radio.